Hello, and welcome to AGH Wealth Management's 2025 Outlook webinar. We appreciate each of you taking time today out of your busy schedules and allowing us the opportunity to share our thoughts and that of our independent broker-dealer, LPL Financial, on the outlook this year. My name is Brad Bechtel. I'm president of AGH Wealth Management. Every 6 months or so, our firm provides our insights and the outlook on the economy and the markets to the year ahead. The slides you're going to see today are available to you in a full color brochure or booklet, which we'll gladly provide upon request. During the presentation today, if you have any questions, please feel free to email us. We'd be happy to discuss those with you after the presentation. My partner in today's presentation is Brian Gensch. He's a certified financial planner, and he's a senior vice president here at AGH Wealth Management. His focus is on overseeing our firm's personal investment portfolio and strategies, as well as our comprehensive financial planning services. At the conclusion of today's presentation, email or call Brian or I, and we'll be happy to continue the discussion or answer any questions you might have. Without further ado, I'm going to turn the mic over to Brian.
Thanks, Brad, and thanks everyone for joining us today, letting us share these perspectives that we have. The slide deck that you'll see today was created by our research team at LPL a few months ago. We typically like to do our outlooks in the February timeframe with our 6-month review, usually in August. So while the slides may or may not be fully updated, our discussion will include all updated information on the markets and the economy today. So as usual, we'll take you through the economic landscape, the stock market, and then the bond market environment in today's presentation. Then we'll talk about a few other things as well. But we'll first start on the economy. So as we enter this year, the economy and the economic landscape remains pretty complex, marked both by opportunities and some potential risks. Between the foggy outlook for inflation and economic growth concerns, questions are arising as to how resilient this economy really will be through this year. Will inflation stall? Will it rise? Will it move down again to the Fed target rate? And how will the Fed react, and how will the tax environment change with policy reform? Currently, there's probably as many questions as there is clarity on how the new administration will affect economic stability. Executive orders are rampant over the first month of Trump's presidency, and the most economically important ones are centered around tariffs, immigration, the federal workforce, and of course our budget. So how these policies are executed could have a more meaningful impact to our economic health as a country. You mix in all the reversals, court challenges, other mixed signals. Clarity is a scarce commodity today, but it's crucial for many businesses to make a lot of their long-term investments and decisions for the year. So LPL currently has a view that we're late in the economic cycle. And 2025 forecast of GDP would be right under 2%, sitting at 1.9, with an unemployment rate by the year end at 4.8. So in 2024, we had a lot of business owners say that they were going to ramp up capital expenditures, or CapEx, and wait till after the election to do that. Apart from the lack of clarity on tariffs and global trade, the market does seem ripe for a resurgence of CapEx this year. If you think of what makes up GDP, or what measures our economic growth, other than consumer spending, which is the largest piece of that, the other main components of the private sector are net exports, the change in inventory, and CapEx, or we call it business fixed investment. Kind of the broad category for capital expenditures. Further, the demand for power and communication structures are on the rise. Equipment spending is slated to increase. Research and development is making up more of the U.S. economy. So all of this suggests there's potential upside to business spending this year, which would promote economic growth. if we look at consumer spending, which again is the largest part, making up about 2/3 of the overall number that we get for our GDP, demographics will likely be a tailwind to growth in the coming years. Millennials are just about to enter their peak earning and peak spending years because of the amount of households who refinanced mortgage debt in 2021, and because of the rise in real disposable income from our tight labor markets that we've had. We should see some continued strength in consumer spending. By the time we approach 2030, so in the next 5 years, about 75% of the labor force will be millennials. Outside of the raw economic forces giving the economy a demographic tailwind, which is what that would be, the greatest intergenerational wealth transfer is also about to start. And millennials and those even younger will be some of those beneficiaries. And that further strengthens the consumer financially in their peak spending years. Just for perspective, over the next 2 decades, so we're talking 20 years, millennials and younger generations are expected to receive approximately $84 trillion in wealth transfer from the older generations. As a point of perspective, our annual GDP last year was 30 trillion and 2023 was 27 trillion. So there is a lot of potential buying power that's going to be transferred to generations that are in their spending years over the next 2 decades, and that we see as a long-term proponent of economic growth. And while it's not noted in LPL's presentation, it's worth noting that population growth is also very important for the US to maintain a workforce. According to the Census Bureau, for the year ending in June of last year, 2.8 million of the 3.3 million growth that we had in our population came from immigration. Now, 3.3 million is a small number already. It's about 1% growth in population. So we're a very stagnant population. But of that, the majority of that actually comes from immigration. So immigration reform has some interesting risks associated with our ability to grow our workforce. Currently, the president is running well beneath what he had promised as far as deportations happening every day, but it is evident that month-to-month immigration at our southern border is heavily down. And while this feeds the administration's agenda of stopping the trafficking of drugs and the human trafficking across borders, this also has the collateral issue of lowering our population growth through legal immigration, which could be an important part of keeping a sustainable workforce. And that's really the most disconcerting thing about it right now is that with the actions that have been placed on with this administration, legal immigration is creating harder vetting processes, as well as there's a slowdown in processing applications from downsizing. So this will be watched over the year to see how it affects our labor markets, but it's also a component of our population that we need to be mindful of. Because as a organic growth in our country, we just really don't tend to grow as a population. So it's also important to note where the spending comes from. So if you look at the higher income households, they're the ones that really drive consumer spending. And incidentally, the ones least impacted by pandemic-induced rises in rents. And they're also the ones least impacted by tariffs, according to some research surrounding the Trump-Biden tariffs. So the key point here is investors need to watch what the upper income consumers are doing and where they're shopping, how they're managing expenses, because they will be the leading indicator for the rest of the consumer metrics. It's no secret that there's a bifurcation in the haves and have-nots, and the inflation effect has hit the have-nots a lot harder than it's hit the haves. As it relates to economic growth, though, our consumer spending is driven mostly by those in the higher income households. And so knowing how they're spending helps us get a better feel for what our economic growth projections could look like in the near term. So we also want to talk about inflation. Inflation was decelerating through last year, not as fast as the Fed was liking it, but it was decelerating. And barring any true supply shocks or extreme tariff policies that stick, we don't expect inflation to fully reaccelerate, but the path to this 2% target is slow and arduous and maybe stalled right now. In addition, the tariff tantrums we've kind of experienced with them getting announced, delayed, implemented, threatened, et cetera, it creates less clarity about how it will affect our economic inflation numbers this year. Complicating things is the stickiness of one of the pieces of inflation that the Fed focuses on the most, which is owner's equivalent rent, which is an imputed cost, not an actual cost, but it's an imputed cost that affects people's pocketbooks. There's other sticky components like medical care services, insurance. I don't know if you all have seen any insurance increases. I know property and casualty insurance increases are on the rise, both for consumers and businesses. So insurance have kept inflation rates elevated as well. And the slow and sluggish path to this 2% target for the Fed means that they'll likely take this cut and pause cadence in 2025. Of course, we've already seen the pause happen, which was sooner than anticipated at the beginning of the year. Current market expectation right now is that the Fed will hold at the current target rate until at the earliest, maybe the summer, and potential maybe for one more cut left for the end of the year. So this resets kind of a lot of variables for business spending and consumer spending. On the one hand, if it's clear the Fed is not going to lower rates much more, it does take away the incentive to wait to spend. Typically, when we see a Fed rate cutting cycle start, we see consumers and businesses are tempted to wait out a few cuts before they continue, purchasing homes or purchasing businesses or expanding. But with less clarity that rates will keep cutting, it creates actually potentially more of an incentive to go ahead and spend now as the benefit of waiting is diminished. So the next big data point will come at the end of this month on the 28th, and that's the PCE deflator, which is the personal consumption expenditure. That's the one that the Fed looks at the hardest as it relates to its rate policy. And so, we got CPI came in hotter than expected this month. PPI, which is producer price index, so the business's cost, came in a little more muted. So all eyes are going to be on this PCE deflator number coming in at the end of the month, which could set up, how the Fed reacts in their March meeting. So we have a ways to go before we can truly get comfortable about the direction of the economy and the policy changes happening around it. All in all, if we can grow our economy, even at a sluggish rate, keep inflation stable, we feel the markets could focus more than on the earnings and profitability and revenue guidance and growth that would justify its valuations over, big shocks to economic changes in either heavy contractions or accelerated growth. So let's kind of turn and talk about stocks. Stocks have had a pretty uninterrupted run beginning in October of 2022, which was the beginning of this new bull market. The likelihood of the stock market having higher bouts of volatility in 2025 is high. I think if there's one thing from the stock market perspective that you take away from this is that higher bouts of volatility this year is a high potential, given how deep into the bull markets we are and how late in the economic cycle we are. Additionally, with a Fed pause, any amount of anticipated changes, one way or the other, could create some quick repricing in the stock market. On average, and we've talked about this almost, I would say maybe in every webinar we've done, but on average, the stock market has intra-year declines of at least 10% or more each year. So that's an average. 2024 actually mimicked 2017 when there wasn't a 10% pullback. So we've kind of had a smooth ride over the last 12 to 14 months. If you look back to 2017, 2018 brought the first S&P 500 negative market since the financial crisis, and had a 10% and a 20% pullback in the same year. Now, I think the S&P ended like negative 4.7 or something percent, so it wasn't a heavy negative, but there was definitely a stall and an increase of volatility following a year of quietness in the markets. And we don't anticipate that the market would truly have to end this year lower. In fact, the only reason it did it in 18 was because the fourth quarter was where almost the entire quarter was that 20% correction. And so the market just hadn't recovered enough to be positive by the end of the year. And there was some difference in how the Fed was looking at the economy at that point in time. So we don't necessarily take that as a precursor to what's happening this year, but we just do realize that volatility can pick up when things are calm for too long. So the bull market, again, has entered its third year. It celebrated its second anniversary on October 12th of last year. The S&P 500 is up nearly 70%, a little over now, since the move began with a booming year two. So the second year of our bull market, if you look at October 12th to October 12th, ending last year, was 32%. The first year was 21%. A surprisingly resilient economy, unwavering trends in technology, obviously AI, moderating inflation, the start of the Fed's rate cutting cycle, strong earnings recovery after the earnings recession, which we'll talk about, ended all in 2023, and that has driven much of the gains. History does suggest that bull markets have a good chance of celebrating a third anniversary, meaning we can get to October of this year and the third year with a positive return. In fact, in the absence of recessions, the odds that a 2-year-old bull market gets to 3 are pretty solid. For bull markets that get through year 3, the average gain of the S&P 500 is 5%, with 6 of them positive out of 8. The bulls that didn't make it through year 3 were ended by recessions, or an overly aggressive Fed, or in the case of 1987, excessive speculation. We believe the chances of another positive year in 2025 without the start of a bear market decline are quite good. But history tells us to expect more modest gains. This is kind of our language we talk about with clients when we meet is, hey, 2024, 2023, great years in the stock market. Let's not set that expectation necessarily that we should get a repeat for 2025. Longer term, the history of bull markets offers cause for optimism. Since 1950, excluding the current period, the current bull market, the bull markets in the past have averaged about 61 months, so a little over 5 years, and have produced a cumulative returns of about 167% on average. So in other words, while volatility alone is expected, it doesn't necessarily mean the bull market doesn't still have legs to run. And if you think of accumulative gains, I mean, we may be really just halfway through this bull market. So a lot of reasons to be, like we said at the beginning, pragmatically optimistic about where we're headed. After one of its longest pauses in history, the Fed cut interest rates in September and November last year. Now, the question is how much support additional cuts may provide for stocks in the year ahead. As we already discussed, only really one more rate cut would be expected today. It's priced in for this year. Based on the last 9 major rate hiking cycles since the 70s, the S&P 500 has generated relatively modest average returns of about 5.5% during the year following the first rate cut. So you take the first rate cut, look at the year after that, the 12-month period following, on average, the S&P 500 has produced positive returns. And for sure, if you take out the recessionary periods like 2001, 2007, 2020, the median gain was actually more like 10%. So prospects for solid returns in 2025 are favorable if the economy avoids recession. It does not, however, mean that we shouldn't expect volatility along the way. In fact, even in non-recession periods, the S&P 500 experienced pullbacks between 5 and 10% along the way to their double-digit returns. And I'm talking about after those initial Fed cuts. So the only real maybe concerning thing about that today is that the Fed cut their rate in September, and since then the S&P has gone up roughly 9%. So if we end the year higher than where we were at today, we don't think it's going to come without significant repricing or corrections along the way. And when I say significant, I don't mean 20% or more. That would be considered a bear market, but 10 to 15% corrections, things we have not really experienced since COVID and since 2022's bear market. Those kind of corrections can spook investors and become more and more possible as we get later on in this bull market. But we continue to believe that what will drive returns will be significantly affected by our ability as companies to earn profits. So earnings becomes a really important piece of our outlook for the year. And the earnings picture is much improved from a year ago. In the past year, stocks went from an earnings recession and widespread recession fears to a now widely held consensus view that the US economy will continue to grow steadily, perhaps at a slower pace than recent trends, and that corporate profits would still grow double digits. In response to improved corporate profit trends, our research team at LPL is maintaining an earnings target of $260 for 2025, and they've increased their earnings guidance for 2026 to 275, which is about 6% above what it would happen this year. So those are all positive in the form of creating stability in earnings across the broader part of the market. Broadly, corporate America will get some help from AI investments and related productivity gains. The Magnificent Seven, so that's the terminology we coined for the 7 large, heavily weighted in the index of the S&P 500 companies that are primarily in that innovation and tech space: Google, Microsoft, Amazon, etc. They're expected to grow earnings by an average of 17% in 2025. Banks and energy companies should benefit from deregulation in Washington. However, potentially slower economic growth, the potential for rising borrowing costs, and tariffs are among reasons to expect more modest gains than in 2026. And of course, we don't know if there's any cuts to corporate taxes that would offer potential additional upside. What I think this graph shows the most, though, is that the weight of the Magnificent Seven stocks continuing to perform has diminished. And so what that means is there's a more broad-based earnings growth happening, and that it's not all being held up by a few large companies that are increasing pockets of revenue because of AI. So while we still believe AI is real and it's innovating into new spaces and new revenue pockets that many companies have not had, we like to see the fact that the forecasts show not so much of an overweight to where the rest of the market isn't showing good earnings. We're actually seeing better earnings health in the rest of the market. So this isn't a thing to say you have to diversify away from, you don't have to sell your NVIDIA. I'm not making recommendations, by the way, but you don't have to go sell your AI stocks necessarily. We think long-term AI is going to be a huge component of our stock market growth, but it is going to be starting to get more broad-based as well in how our market performs, with the breadth of the market being healthier, and that's a good thing. So also you have to look at sentiment, and there's certain sentiments that show positive, some show more muted, but some measures show some really positive sentiment and at potentially records. And that can risk maybe kind of a near-term correction just because of over expectation. US households are as confident as they have almost ever been that the stocks will be higher in the year ahead, but some sentiment readings, such as those taken from like other markets, like the options market, are more subdued. But any signs of exuberance calls for discipline. It reminds me a bit of a book I read years ago called Switch. It's not actually a book about stock market, but it's about decision making and change. And it talks particularly about how our emotions can easily override our rationality. And this all too often happens in the stock market as well. Behavioral finance tells us that we wait too long to become bullish about our own investments and then too long to become bearish. And because of that, we can't allow our sentiment or emotion to override good decision making. And right now, especially, there's a classic shift of sentiment in consumer expectation based on the power changes happening in Washington. without fail, every time we see a party change in the White House, party lines immediately swap from either negative to positive if you're the new party in charge, or positive to negative if you're losing your political power. So these sentiment shifts are very little to do with what's happening in the economy and the markets, and just much more to do with other aspects of what's causing their confidence levels to go up or go down. So we want to take some of that emotional energy out of our decision making as we look at how to expect what to expect in the coming year with the stock market. So expect volatility, and then you won't be surprised when we get it. The biggest challenge here is that if you're anticipating a stock market correction, the part of your portfolio that classically, historically was a good diversifier, bonds, they have not been our friend recently. So we're going to talk about bonds. And I would say that the hardest market to have been invested in over the last 5 years has not been the stock market, even with its COVID reactions, its interest rate hike volatility in 2022. But it's been the bond market. Bond prices are highly correlated to changes in long-term rates, namely the 10-year Treasury. And by correlated, I mean negatively correlated. So they go one way when the rates go the other way. And that has been one of the most difficult aspects of investing in the last 5 years in the bond market. Where we stand today, bonds are paying much more in income than they have in the last decade. And they have virtually experienced no growth over the last 5 years. And so we do maintain that they can be a good diversifier against recessions, but they're more of a subpar help when we get into inflationary environments, as we obviously experienced in 2022. So the current market pricing suggests that the Fed will take the Fed funds rate back to about 4.25% in 2025. That's assuming one more rate cut happens. If markets are right and the US Treasury yield curve eventually reflects its historic upward sloping shape, that likely means that the 10-year Treasury could be pressured to move slightly higher above its current levels. The spread between what the Fed funds rate is, the one that they change, and then the 10-year Treasury has on average been around 1.1% in non-recession periods, meaning the 10-year Treasury yield has been higher than the Fed funds rate by about 1.1%, albeit with a larger range when not in recession. So unless or until economic data starts to show signs of a sustained slowdown, the 10-year could fluctuate between 4 and 5% through the rest of this year. And we're right kind of smack dab in the middle of that right now. But if the economy does show signs of slowing, the Fed could resume cutting rates more than what is priced in, which would mean the 10-year Treasury could actually have some relief and push back down to 3.75 or 4% by the end of the year. But at the end of the day, if Treasury yields just stayed in range for the year, bonds will actually be able to produce good income without much principal risk. The challenge is if the 10-year Treasury rate rises for multiple reasons, but one including what we're looking at here, then that puts pressure on those bond prices. And so we want bonds to be boring, and we want bonds to be our safe haven investment in recessions. Bonds don't necessarily have that same effect in inflationary environments, and especially if the Fed would maybe pivot and start raising rates, which we're not calling for, but again, we have to put everything on the table at this point for this year. So there's some pressure that could happen either way, and we're just a little too early to know which direction that's headed because of the pause that we've experienced. So another way we follow the relationship between short-term rates and long-term rates is what we call the Treasury term premium. The term premium is basically saying the additional compensation that you would require to buy a longer-term Treasury, something that matures longer, term, versus what you're getting paid to own a short-term Treasury. So it's really it's kind of an unobservable, it's approximated value, but it considers a variety of factors, including the supply-demand dynamics of treasuries, foreign central bank expectations, the possibility of future inflationary pressures. And so after years of a negative term premium, investors are just now getting compensated for owning longer maturity treasuries. So that additional compensation is still below long-term averages. So how does this affect our bonds? How does this affect our fixed income investors? Well, a positive term premium could keep longer term interest rates elevated, perhaps reducing that diversification benefit of core bonds. Regarding the former, while monetary policy expectations will continue to be the dominant driver of interest rates, so what the Fed does will continue to drive, dominantly the interest rate changes. Fed rate cuts may not have the complete desired effect. And so longer term interest rates may not just fall as much as they would have with a positive term premium. So what that means is if the Fed comes in and says, hey, we're going to keep cutting rates, it doesn't necessarily mean that the 10-year treasury will drop. And so that affects where we think we need to be inside of a bond portfolio. So while we still believe treasury securities can be a safe haven choice in the case of a broad macroeconomic market and equity sell-off, they may not be the best defense mechanism for any sort of garden variety sell-off that we see in the stock market. Additionally, when we look across like foreign central banks, we're seeing an issue with the demand for treasuries, and we've noticed that for, I'd say, decades now. We're still the reserve currency, but we're becoming less and less purchased by foreign central banks. And recently, in fact, one of the things that I saw, I think I read last week, was central banks are actually focusing more on planning to add more gold in their pile as an anticipation of strong dollar and U.S. tariffs. So the demand to own treasuries may only increase if we see them as a safe haven investment. So that's the demand side. Then we have a supply issue. So while economic growth will remain the driver of interest rates, the secondary risk to rates remaining the amount of treasury debt to fill our budget deficits. So per the Congressional Budget Office, the U.S. government is expected to run sizable deficits over the next decade to the tune of like 5 to 7% of our GDP each year. And to fill those deficits, the Treasury Department will need to issue trillions more in Treasury securities. But what's complicating the math for the Treasury Department, and regardless of if this current administration throws in a bunch of budget cuts, is the Treasury Department will also need to roll over more than $6 trillion in Treasury securities set to mature this year. And a lot of that came from the treasuries that in the last 4 years, what Janet Yellen did as the Secretary of Treasury is bought shorter term treasuries thinking that rates would come down and we could refinance those quickly. And what's happened is our treasury rates really haven't come down. So now we're getting all these maturing and we're going to have to reissue debt to cover our matured debt, not to mention any deficit that we do end up having still. So we're talking $6 to $8 trillion of debt needing to be issued over the next 12 months. So that's a heavy supply. And if our demand side is waning and our supply side is increasing, guess what that does? That puts pressure on the 10-year treasury yields and the other ones, 7-year, 3-year, however they issue the auctions, to have higher interest bearing debt, which again stagnates the bond market from having any sort of above average return. So despite the mountain of debt and growing interest payments, the government is not what we consider a risk of financial collapse, nor are there concerns as such. So as long as treasuries are considered risk-free securities, and I think given the day, we can decide how risk-free that may feel. But as long as they are still considered risk-free, there will always be buyers. So we're not going to lose all of the demand. There will always be buyers of treasuries, full stop. But with the Republican sweep of Congress and the White House, the deficit will likely remain broadly unchanged at elevated levels in the coming years with the Trump proposals. And I know in the news, we're talking, with Doge and everything, we're talking about all the cuts we're going to be making. At the same time, history, if it repeats itself or rhymes, anytime one party, doesn't matter which side, is fully in power, it tends to put pressure on the budget because of the agendas that get run on either side. So will they be able to offset that with cuts? Yet to be seen. Obviously, there's been a lot of volatility in that, and that seems to be a very fluid situation that changes daily. So with pressure on interest rates, the bond market may not be set up for any above average return, but the income produced off of a bond portfolio today could satisfy many investors. And so despite the long-term rate environment, bonds will still be needed in portfolios because they will have a, minus a super inflation period where the Fed then has to raise rates. We believe that bond income will at least offset any price volatility, and that income will be able to be paid out to our income investors. And so bonds can be still used as a safe haven investment for economic slowdowns in the future, knowing that there could be volatility in the meantime if we see an increase in inflation. So it's the trickiest part, I would say, between stocks and bonds. We definitely see that as the trickiest part for portfolios. And before we get to alternatives, I would just say too, under the bond market, there's a lot of ways to own bonds. Not every bond is affected the same by treasury yields. So we realize that as well. You can diversify across less interest rate sensitive bonds, global bonds. There's a lot of ways to maybe diversify away from the 10-year treasury or the US issues or the strong dollar. We've done some of that in our models, and we are very focused on duration, which is interest rate sensitivity, and we would say that a shorter duration bond portfolio makes more sense right now if you're not also using then international bonds. So if the stock market could have more volatility and the bond market could show below average returns, where else can investors find diversification, or where else can they find opportunities? This typically brings us to talk about alternative investment vehicles, and that can help diversify away more risk. LPL Research does a lot of work with looking at liquid alternative investment structures. We expect, lower rates and shifts in policies will be key drivers for the market this year. So there's these things called equity market neutral strategies. They could be one of the beneficiaries of this backdrop as the uncertainty around the new Trump administration policies lead to increased volatility. And so there's strong fundamentals in things like long short funds and market neutral stock pickers. We've found a lot of success as well in looking at hedged equity ways to invest in the market. And so there, and then you add in currency and commodities, and there's a lot of other ways to invest. But with the landscape today, we feel that the strongest fundamentals are for long short, hedged equity and market neutral stocks strategies. And that is one other way you could potentially diversify. Obviously, that's a specific to each individual investor portfolio. So we're happy to reach out and talk about those in more detail individually. LPL also remains positive on multi-strategy, what they call like pod shops, as they continue to deliver results. So these are, where there's multiple fund strategies happening inside of one fund. And we utilize some of these multi-strategy funds in our models. We have an alternative model that we run for some clients, and so there's a multi-strategy there that we use. So there are ways to diversify across the bond and the stock market. And again, at AGH, we do embrace alternatives, but our main focus has really been the hedged equity strategies, which is really purchasing the stock market and then overlaying through options, overlaying insurance on it. And these have more predictability, and we've had a lot of success in this arena. So the point is there are ways to diversify against traditional markets in liquid portfolios. And if you're worried about the stock market or the bond market, those are ways you can help your portfolio diversify away from that risk. One question we get a lot recently is how the geopolitical environment could just upend the markets. And so the final slide I want to show you is just, if you look at history, what you'll see is that markets have navigated successfully a series of high risk scenarios throughout history. Even significant market downturns caused by recessions, exogenous shocks, or liquidity meltdowns have ultimately led to stronger, more resilient markets with more attractive valuations. The point we are making here is that while geopolitical risks could be what creates a pullback in the market, today we look at that as a buy the dip type of opportunity rather than sell the rally. So with all that being said, we believe that looking at this year, 2025, with pragmatic optimism is appropriate given the economic earnings and the interest rate landscape. So I want to thank you for your time today. I hope that this has been a value add. As a reminder, our research team at LPL puts out a monthly client approved report of their pulse on the markets and the economy, what sectors they favor, what sectors they don't in the stock bond market, alternatives, asset classes. Anytime you want to know where our research team at LPL is, we'd be happy to show you their thoughts and their report that they put out monthly. Please don't hesitate to contact us as well if you have any questions or would like more information on maybe even your own investment portfolios. Please remember that when you invest, we always say this, maintaining a long-term time horizon is critical in order to reach long-term financial goals. So you have to match your time horizon and your risk appetite with those objectives, and that's what needs to be the main components of any portfolio shifts that you're making or any changes that you make, not the news of the day and what that might mean for the market for the next week. So maintain that longer term horizon. Even that longer term means 2 years. Maintain that longer term horizon as it relates to what your actual objectives are for the money you're investing. So as we're seeing through these disclosures, I want to just make sure that you're aware that Brad and I are going to be available for questions post meeting, and I'd like to just go ahead and hand it back to Brad for any closing comments. Brad?
Yeah, Brian, thank you very much, and great job this afternoon. I want to thank everyone for joining us today as we shared the insights and our outlooks on the economy and the market ahead. As Brian and I both mentioned at the beginning of the presentation, a copy of the slides are available to you in a full color booklet. We'll be happy to mail that out to you if you just want to let us know you'd like one. Please feel to reach out to either Brian or I if you've got any questions regarding the presentation. I think Brian really said it well. I mean, it's as we navigate these markets ahead, a good strategy, a good plan, and probably not shooting from the hip is sometimes the best thing we can do for ourselves. So again, thank you all for your time and your interest today in the presentation. And this concludes the presentation.
Thank you.